Condo sales in some major Canadian markets are continuing to drop to lows not seen in decades. It has some condo owners looking to offload their properties, worried that things will only get worse.
The condo market continues to be struggling. Condos, however, now that would have previously turned around quickly are simply not moving. Condo sales in the Greater Toronto Area dropped by 23.5% in March. That's according to the Toronto Regional Real Estate Board.
For years, Toronto's skyline looked unstoppable. New glass towers kept rising, cranes etched the horizon, and the city became a global symbol of urban boom. Condos weren't just homes. They were currency, security, and identity. Buying one felt like a rite of passage, or a ticket into the middle-class dream that defined 21st century Toronto. But something happened. Something that few saw coming, and even fewer are ready to face. By late 2025, the numbers told a different story. Condo prices had dropped nearly 18% from their pandemic highs, and inventory, the number of units sitting unsold, had exploded to levels not seen since the early 1990s. Pre-construction sales, once sold out within days, were now struggling to find buyers even after deep discounts. Developers who once bragged about sold out in 48 hours were quietly freezing projects, refunding deposits, or remarketing units at fire sale prices. Bankers, too, began whispering about risk, about construction loans that no longer made sense, and about entire towers whose financing was suddenly in question. The once unstoppable Toronto condo market had begun to stall. And that stall is now turning into something bigger, a systemic unwind. For years, condos were Toronto's economic engine. They employed tens of thousands of construction workers, powered the city's tax base, and fueled everything from real estate commissions to furniture sales. But when confidence cracked, the machine jammed. It began with a quiet shift. A few projects delayed here, a canceled pre-sale there. But like all bubbles, the real panic started when people realized it wasn't temporary. Maya, a 32-year-old nurse from Scarborough, remembers that moment vividly. She had saved for 5 years, putting $65,000 down on a pre-construction one-bedroom unit in Etobicoke. The sales agent told her it was a can't-lose investment. She believed them. But 2 years later, in early 2025, she received an email from the developer. The project was canceled. Rising construction costs, higher interest rates, and slower pre-sales had made the financing impossible. She was promised a refund, but months later, the check still hadn't arrived. "I thought I was building my future," she said. "Now I'm just trying to get my money back." Maya's story isn't rare. Across the Greater Toronto Area, dozens of developments have been canceled or indefinitely paused. A report by Urbanation shows that condo starts, the number of new projects breaking ground, are down 57% in the second quarter of 2025 compared to the year before. Developers are sitting on land they can't build on. Banks are freezing new loans, and buyers are walking away from assignments, resale contracts for units not yet built, because they're now worth less than they paid. The assignment market, once a hotbed of flipping, has collapsed. In 2021, you could sell a pre-construction contract for $100,000, more than you paid before the building was even finished. Now, many are trying to sell at a loss and can't find any buyers at all. So what happened? The simple answer: interest rates. The Bank of Canada's rapid tightening cycle, meant to curb inflation, sent mortgage rates soaring from 1.5% to nearly 6% in under 2 years. For investors, that destroyed the math. For developers, it destroyed the financing model. Pre-construction condos are financed differently from regular homes. Builders need at least 70% of their units sold before a bank will release construction funds. But when buyers vanish, that threshold becomes unreachable. Without financing, cranes stop moving. At first, developers tried to hold out. They offered incentives, free parking spots, upgraded appliances, or cashback at closing. But those gimmicks only went so far. By mid-2025, sales offices were eerily quiet. Some builders turned to international buyers, especially from Hong Kong, China, and the Middle East, hoping foreign investors would pick up the slack. But even those investors began to hesitate. worried that Canada's once guaranteed appreciation story was over. The shift wasn't just financial, it was psychological. For 2 decades, Torontonians believed real estate could only go up. That belief fueled everything: pre-sales, speculators, even political promises. When that belief cracked, the system began to unravel. Real estate agents described the mood as shell-shocked. One veteran broker said, "People used to fight over floor plans. Now they ask if the building will even finish." The panic spread quickly through the construction industry. Job postings dried up. Subcontractors stopped getting paid on time. Some small firms went bankrupt waiting for invoices to clear. The ripple effects reached deep, from concrete suppliers to real estate lawyers, from mortgage brokers to furniture retailers. It's not just a market correction, it's an ecosystem in freefall. Meanwhile, City Hall is caught in a bind. Toronto desperately needs more housing. The federal government has tied billions in funding to new zoning reforms and faster approvals. But if developers won't build, or can't, those targets are meaningless. Officials in Ottawa and Queen's Park are now debating whether to step in with loan guarantees or tax breaks to restart stalled projects. But that raises another question. Should taxpayers bail out an industry that profited from years of speculation? It's a political minefield. On one hand, there's the fear of a deep construction recession, a collapse that could wipe out tens of thousands of jobs. On the other, there's moral hazard, rescuing developers who over-leveraged and over-promised. Behind closed doors, bankers and policymakers are reportedly discussing orderly liquidation strategies, ways to let some projects fail without crashing the broader economy. It's a delicate balancing act. Yet amid the fear, some voices warn of an even deeper danger, the risk of a future housing shortage. If today's projects don't get built, tomorrow's supply will vanish. That means that after this downturn, rents could soar again, and affordability could worsen even more. It's the cruel irony of housing cycles. Booms create bubbles. Crashes create shortages. Developers like Mark Leong, who has worked in Toronto for 20 years, say they've never seen sentiment fall so fast. "We used to worry about delays," he said. "Now we worry if the lender will even show up." His latest project, a 45-story condo downtown, was 80% pre-sold when construction costs suddenly jumped by 25%. Steel, concrete, insurance, labor, everything soared. His lender pulled back, demanding higher equity. Investors bailed. The project is now frozen, even though the site is already excavated. "You can't just turn off a crane and walk away," Liang said. But that's what's happening across the city. Walk through Toronto's waterfront or its suburban fringe, and you can see it. Empty lots, silent cranes, and half-finished towers with no workers. Buyers who signed contracts in 2021 are now stuck in limbo. Some have paid deposits totaling $100,000 or more. Their money is sitting in trust, waiting. But if the developer goes bankrupt, recovery can take years. In WhatsApp groups and Reddit threads, frustrated buyers share updates, screenshots, and rumors. One popular thread tracks every canceled project in real time. Another lists lawyers specializing in deposit recovery. It's the new reality of a market once defined by hype and hope. Economists warn that Toronto's condo downturn could spill into other sectors. Construction accounts for nearly 7% of Ontario's GDP. If that slows sharply, it could drag the entire provincial economy with it. Retailers are already feeling it. Home improvement stores, appliance outlets, and even interior design firms are reporting weaker sales. The knock-on effects are real and painful. For renters, the story is equally complicated. With fewer condos being completed, rental supply could dry up just as population growth continues. The result? Prices that refuse to fall, even as ownership collapses. It's a paradox and a warning. By the end of 2025, analysts expect nearly 35,000 condo units originally scheduled for completion to be delayed or canceled. That's the largest disruption in Toronto's housing pipeline in decades. For policymakers, this is a crossroads. They can either intervene with subsidies, guarantees, or rate relief. or let the market correct itself, however painful that may be. Either way, the consequences will shape the city for a generation. Toronto's condo boom wasn't just about real estate. It was about belief. Belief in growth, in immigration, in the idea that this city could expand forever. That belief built towers, created fortunes, and defined a decade. But when belief breaks, markets change. No one knows what the new Toronto will look like. Some say this is just a correction, that once interest rates fall, buyers will return, cranes will move again, and prices will rebound.